Okay, so imagine this, right? It's 1998, and you're like one of the most powerful CEOs on Wall Street.
Oh, wow.
You're used to, big deals, billion-dollar decisions, the whole nine yards.
Right.
But this time, you find yourself crammed into a folding chair at the Federal Reserve,
Huh.
not for like some national crisis or anything,
Right.
but to figure out how to bail out a single hedge fund.
Right.
That's the kind of power long-term capital management LTCM had, even as it was about to implode.
It's crazy how LTCM's collapse just showed everyone this fundamental truth about markets.
What's that?
They're driven by, both the cold, hard math and the unpredictable human behavior.
Totally. Even with Nobel Prize-winning economists running the show,
Yeah.
they couldn't predict everything.
Nope.
So we're diving deep into LTCM today.
Good.
You provided some really great source material that explains how it all went down.
Yeah, it's a story that has a lot to teach us.
Even now, about risk, hubris,
For sure.
and how even, geniuses can get things spectacularly wrong.
It's not just about a hedge fund failing either.
What do you mean?
It's a case study.
Okay.
It helps us understand how financial systems work, where the vulnerabilities are,
Right.
and why those lessons are still so relevant, even today.
To get the full picture, we got to rewind back to the early 1990s.
Okay.
So picture this, right? Booming stock market, everyone's making money.
Good times.
But there's this underlying nervousness,
Oh, yeah.
Investors want those high returns, obviously,
Of course.
but without all the risk.
Makes sense.
That's where hedge funds entered the scene. You might be thinking, what exactly is a hedge fund?
Good question.
They're often kind of shrouded in mystery, right?
Totally.
Unlike mutual funds, which are open to, the average investor,
Mm-hmm.
hedge funds are exclusive, like clubs for the ultra-wealthy. Institutional investors,
Right.
higher fees, more complex strategies.
Regulation.
Exactly.
Yeah.
They were seen as the key to unlocking those incredible returns while supposedly minimizing risk.
Interesting.
Leading the charge was John Meriwether,
Go.
Wall Street legend.
Oh, wow.
From his time at Salomon Brothers,
I see.
known for his sharp mind and ethical trading practices.
Huh?
So when he launched LTCM,
Yeah.
it attracted some of the brightest minds in finance.
Like who?
Well, not just A and Y bright minds.
Oh.
Meriwether brought on Myron Scholes and Robert Merton,
No.
2 Nobel laureates
Wow.
whose work revolutionized Wall Street's approach to risk.
Oh, so?
They created a mathematical formula, the Black-Scholes model,
Right.
for options pricing.
Yeah.
It was a game changer.
So they had this amazing team and
Yeah.
these groundbreaking formulas. Must have felt like they had it all figured out, right?
Like they had cracked the code
Yeah.
to conquering the market.
There was definitely a sense of invincibility
Really?
in those early years. Their model was built on this idea that markets were becoming more efficient,
Okay.
and they were betting on these tiny price differences.
Tiny.
Yeah, or spreads between similar assets,
Okay.
believing those spreads would eventually converge.
Arbitrage.
Exactly.
So they were buying low in one market, selling high in another,
Yep.
trying to profit from those small discrepancies.
Precisely.
But to maximize those profits, they used leverage,
Well,
borrowing vast sums of money.
to amplify their bets.
Exactly. It worked brilliantly for a while,
I bet.
generating huge returns for their investors.
So their models were working. The money was flowing in.
Mm-hmm.
Where did it all go wrong?
That is the million-dollar question.
Yeah.
The problem with any model is it's only as good as its assumptions.
True.
And sometimes even the most brilliant minds
Yeah.
can miss crucial signals
Uh-huh.
or underestimate the impact of unpredictable events.
Right.
Even within LTCM, there were
Yeah.
people warning about the risks, but they were largely ignored.
So even with all that brain power,
Yeah.
there were cracks appearing.
This is where it gets really interesting,
I agree.
and I think we have a lot to unpack here.
For sure. It's easy to just get caught up in the math,
Right.
right?
Yeah.
Especially when it's, bringing in those huge wins.
Makes sense.
But as the LTCM found out,
Yeah.
even the most sophisticated models
Mm-hmm.
can't account for everything,
Right.
particularly the unpredictable stuff.
Human behavior,
Likely.
saying everyone has a plan until they get punched in the face.
Right.
And for LTCM,
Sure.
That punch came in the form of the Asian financial crisis.
Oh, 1997?
Yep, 1997.
Suddenly, like, markets just weren't behaving.
How so?
Currencies were plummeting, stock markets crashing.
Oh.
Investors were panicking.
Yeah.
Dumping risky assets,
Trying to find safer ground.
Exactly.
So the very foundation of their strategy,
Yeah.
those tiny spreads, started to widen instead of converging.
Yeah.
And wasn't there like a canary in the coal mine moment?
Oh, totally.
Off
Salomon Brothers.
Meriwether's old firm.
Yep. And a major player in arbitrage.
Right.
They decided to shut down their arbitrage unit.
Really?
They saw the writing on the wall,
Yeah.
acknowledged the rising risks.
So they were basically saying, like,
Well,
this isn't working anymore. It's getting too risky.
Too much.
But LTCM, with all their genius
Yeah.
and complex models,
Right.
didn't heed the warning.
No.
They doubled down, convinced their models would, like, see them through,
That's the hubris.
believing they were smarter than the market.
Totally.
But how did things unravel so quickly?
Well, the final nail in the coffin
Yeah.
came in August 1998
Okay.
when Russia defaulted on its debt.
Oh, wow.
Sent shockwaves through the entire global financial system.
Yeah.
Investors went into full-blown panic mode.
So the opposite of what LTCM had been betting on.
That was happening. Those spreads were exploding.
And their leveraged bets
Yeah.
were, like, magnifying their losses.
Exponentially.
It was a perfect storm.
Wow.
Their models, they relied on historical data
Right.
and the assumption of,
Rational market behavior.
yeah, they just couldn't cope with this, like, global panic.
You mentioned leverage earlier.
Uh-huh.
Can you explain that a bit more?
Sure.
For those of us who don't have, a PhD in finance,
Right.
why was that such a crucial factor in LTCM's downfall?
Okay, so imagine you have a lever
Okay.
and a heavy object you need to lift.
Mm-hmm.
Leverage is like using that lever to amplify your force.
Okay.
It lets you move something much heavier
Yeah.
than you could with just your bare hands.
I see.
In finance, leverage means borrowing money
Right.
to amplify your potential returns.
So LTCM was basically using borrowed money
Uh-huh.
to make these massive bets,
Oh, exactly.
assuming those bets would pay off.
And when things were going well, leverage was their secret sauce.
It supercharged their profit.
But when the tide turned,
It became their Achilles heel.
those amplified losses wiped out their capital.
Yeah, leaving them on the brink of collapse.
Welcome back. So we've seen how LTCM,
Yeah.
with its, dream team of Nobel laureates and complex models,
Right.
they took the financial world by storm,
They did.
only to be, like, brought down by their own hubris
Right.
and a bunch of unpredictable global events.
Yeah, it's a wild story.
But it doesn't end there.
Oh, no, not even close.
It gets, like, even more interesting.
What happened next was unprecedented.
Okay, tell me more.
So picture the Federal Reserve, right?
The heart of the American financial system.
Exactly.
Calling an emergency meeting.
But it's not for, like, a failing bank or some national crisis.
No.
They called Wall Street's most powerful CEOs
Wow, for what?
to figure out how to bail out a single hedge fund.
LTCM.
LTCM. Yep.
That's insane.
I know, right?
I mean, this wasn't some, like, small-time operation.
Oh, no.
LTCM had billions.
Gullions, yeah.
And they were connected to, like, every major bank.
Pretty much.
But why the bailout?
Why?
Yeah, if they were failing, shouldn't they just,
Go under.
yeah, go under?
It all comes down to systemic risks.
Systemic risk, huh? What's that?
Think domino effect. If LTCM went under,
Yeah.
it would have triggered this chain reaction
Defaults, losses.
across the entire system.
Leading to.
A global credit freeze. Potentially.
So letting them fail
Yeah.
has been like...
Pulling the thread that unravels the whole story.
Exactly. And no one wanted to see that happen.
Not even the Fed.
So they had to intervene.
To prevent a total meltdown,
So what happened?
did the government just hand over a blank check?
Right.
Not quite.
Okay.
Lots of tense negotiations, finger pointing, the whole bit.
Yeah, makes sense.
Ultimately,
Yeah.
14 major banks,
Wow.
orchestrated by the Fed, of course, agreed to a $3.65 billion bailout package
To stabilize LTCM.
to stabilize LTCM, prevent wider panic.
A private company bailed out by its competitors.
Yeah.
Under the watchful eye of the Fed.
It's pretty ironic, right?
It is.
The firm that claimed to have mastered risk
Yeah.
needed a massive rescue.
To avoid bringing down the whole system.
It really highlights the limits of models,
Yeah, I see that.
the danger of relying on them too much.
Right.
And it shows how important the human element is.
Oh, interesting.
Greed, fear, panic.
Yeah.
These emotions can drive markets.
And models can't always predict that.
Nope, not always.
Okay, so this all happened over 25 years ago.
It did.
Why should we, care today?
The parallels between LTCM
Yeah.
and more recent crises like 2008,
2008, yeah.
they're striking.
How so?
Excessive leverage, complex instruments, blind faith in models.
Right.
These same patterns, they keep popping up.
And they often have, disastrous consequences.
Yeah.
Almost like we're doomed to repeat the mistakes of the past.
Hopefully not.
I hope not either.
That's why, understanding LTCM is so important.
Right.
It's a reminder
Of what?
of the importance of humility,
Mm-hmm.
the need for strong risk management,
Right.
and the fact that, financial markets are driven by people.
With all their flaws.
Exactly. All their flaws.
So what can we learn from all this?
A lot, actually.
What?
It reinforces the importance of diversification.
In our investments.
Yeah, understanding the risks of leverage
Mm-hmm.
and recognizing that even the smartest people
Can make mistakes.
especially when driven by hubris and overconfidence.
That's great advice.
Thanks.
It's a reminder to, approach the markets with a healthy dose of skepticism.
Yes.
And to, question assumptions.
Always question assumptions.
Even when they come from experts.
Especially when they come from experts.
Well, that's all the time we have for today's deep dive into LTCM.
It was a good one.
Thanks for joining me.
My pleasure.
And thank you for listening.
See ya.